Jessica, thank you so much for coming on the Advisor Lab. We love having you on the show. Appreciate it.
Thanks for having me. I'm happy to be here.
For our audience who aren't familiar with your firm, Turkey Hill Management, and obviously what you do, maybe share with the audience a little bit about your business, your journey to founding it, and really, what the market environment's like right now for what you're doing.
Okay, that's a lot of questions. So I guess I guess by way of background, my personal background is in mergers and acquisitions. Historically, it was for both the wealth management industry and also the institutional asset management industry. When I founded Turkey Hill 4 years ago, I decided to focus exclusively on the wealth management industry. And the question was, how can we do it in a way that resonates more with the clients that we serve? And when you think about your typical independent fiduciary, they are fee only or at least fee based, because they want to look their client in the eye and say, hey, the advice that I'm giving to you is because it's best for you, not because I make more money if I have you do it this way versus another way, right? And then when it comes time to sell your business, you have to go hire a registered broker dealer who takes commission on the sale of a security. And that security just happens to be your life's work. It's so counter to how your average RIA operates on a day-to-day basis that I said, well, then let's not. Let's not charge a success fee at the completion of a deal. Let's charge a monthly retainer that's cancelable at any time so that the client never has to question whether the advice that we are providing them for potentially the biggest business decision of their life is in their best interest or in ours. And that is kind of the foundation for the entire process that we run at Turkey Hill, where we're really putting the client first, spending the time up front, getting to understand their concerns and their needs and what's important to them and what their deal breakers are, so that we can then take them to market telling the story of the baby that they built over the last 10, 15, 20, 30 years and bring them to people with whom that story resonates. We are creating lasting partnerships. We are not transacting. We're not rolling up car washes, right? We are taking assetless businesses and partnering them with others for the benefit of all of the clients that have trusted their life's work with them. So we are predominantly sell side. I think last year we closed a dozen deals. This year we'll probably close, I don't know, 15 to 20. So we're very active in the space, really ranging in size from, 200 million to many, many billion and everything in between. So that's a little bit about us. Do you want me to pause or do you want me to continue talking about the market and what we're seeing?
Take a second. You mentioned a couple things. I mean, obviously, it's a matter of public record how much PE money's flown into the RIA and family office space, and they love asset-light businesses with reoccurring revenues, and so this is tailor-made for them. It seems like the business has gone like almost full circle, where folks went from I want to leave wires for more autonomy, better payout, less compliance headaches. And now you've got the high towers and the dynasties, and they're all becoming these massive aggregators. They are at massive aggregators. And perhaps being brought back to what now becomes a big corporate bureaucracy might change the trajectory or the trend. I'm curious your professional opinion. Like the trend's clearly still in the direction of more going RIA. But is there anything that you see? Is that possibly something that's an impediment, or do you see it through a different lens?
Yeah, as you can imagine, I have a lot of thoughts about this. I think first, at a high level, context is important, right? So you mentioned like a high tower, right? A household name that has, over $1 trillion under advisement, but only a few hundred billion under management. And you contrast that with the Morgan Stanleys and the Goldman Sachs, and you realize we're still talking about small potatoes compared to the large wirehouses where you are asked to make sure that your high net worth client is also getting their mortgage through your business and using us for insurance, and like how many other ways can we extract fees from this client. in contrast to, a Hightower, a wealth enhancement group, kind of the behemoths in our little industry, who still are fee only, right? Or at least fee based. And I think it's important to take a step back and realize that yes, there are consolidators and there are, household names to us who are in the industry, but you talk to your average anesthesiologist and they still have no idea who these firms are, right? There is still a massive amount of consolidation that can occur in a rapidly consolidating environment, where we can still uphold the values of being fiduciaries in a way that is just different than, at Barclays, right? So I think that's important context just in general. You mentioned private equity, which is also a hot topic because private equity has entered into the wealth management space in a very meaningful way in the last, I don't know, 5, 6 years. And what's interesting is that they have gone, and I'll put this in quotes, right, like down market as far as the firms that they're willing to invest in. So, maybe 10 years ago, it was, one or two private equity firms that were going to invest in the $100 billion plus firms. Otherwise, it wasn't worth their money. What we're hearing now is if you have $5 million of free cash flow, you're big enough for private equity to be interested. And what that's done is capitalize many more 10 billion, 6 billion, $15 billion firms, which has then flooded the market in a positive way. I use the word flooded positively, with new buyers. So we no longer have to consolidate into, pick one of 5 names that everyone can kind of recite off the top of our heads. There are more options than ever before to get fair value for your business and also have the opportunity to make an outsized impact on a firm that still has a really big growth trajectory, but still really upholds a fiduciary standard and operates as an independent entity, right? Just a larger version of, a $500 million independent RIA.
Okay. So you don't have to lose that independence. That's a good point. With what you're seeing in the market, one, you said it's very active, which is interesting because my firm, Scion Investments, we raise capital in private credit, and we obviously are hearing deal flow is slow. There's not a lot of M&A right now. PE is, a lot of the LPs are waiting for their money to come back in distributions. But it's very nuanced, right? In your space, it's extremely active. I'm curious, is it more active from your side of the table for people that you're working with who want to buy or sell, or is it down the middle?
So we advise mostly sellers.
Okay.
So maybe I have a biased view. What I will say is that, kind of like what I was saying before, there are more firms interested in being buyers than ever before. There are some that have more attractive and well thought out value propositions than others. But because there's been such a boon in M&A in the wealth management space in particular over the last, I don't know, 4 or 5 years, activity begets activity, right? As an RIA owner, it's impossible not to be part of a study group, a peer group, a neighborhood cocktail hour, whatever, where you don't know someone that has sold their RIA in the last few years. And humans are humans, and they ask questions, and by osmosis, one way or another, people are becoming more adept to what's going on in the market, where multiples are, how buyers are thinking about what is attractive and not attractive in acquisition targets. So it continues to drive interest among sellers. So something that's interesting that's happened is, where maybe 5 years ago, our average seller age was 65 to 70. And they were selling because they're slowing down. They don't want to run their business anymore. They don't have a succession plan, or the business has become too expensive for their succession plan to buy them out. We're now seeing sellers in their 40s and 50s who are interested in capitalizing on the attractive valuation multiples that we see in the market right now, but are also astute enough to realize if they can partner with a smaller growing firm and take equity in that firm, they're actually more likely to create long-term, like generational wealth for themselves and their family because they're able to ride the growth of a much larger, faster growing firm than their own, while also having a nice career trajectory for themselves because they're not looking to retire immediately, and can rise the ranks within a larger firm with more opportunity for them and for their employees and for their clients. So there are a lot of factors kind of leading into why M&A is so hot right now and has been for the last few years. And I suspect that's not going anywhere, because as the seller market evolves, so does the buyer market. Um, and buyers, because of the amount of buyers that exist in the universe right now, continue to evolve their thinking about how to go to market and differentiate themselves among some of the other buyers that exist. So it's a continuous cycle that I think
Yeah,
will
that's a
continue.
really good point you made about the average age has really come down. And I was mentioning this to you before. I was sitting in a meeting and Cerulli and they're talking about it was crazy. The number of folks going RIA has, we all know, continues to increase up and to the right, up and to the right. But 21, 22, they told me 2,100 new RIAs. Just to put that in context, about 400 to 500, they said every year. You get new RIAs every year. So to do 2,100 is an insane number. I don't know if
Insane.
that's part of the results of COVID. People who were wired were like, oh my gosh, too much compliance. I want to be in the office. Who knows? Um, but clearly, there's a reason folks are going. And a lot of folks are more interested in what you just said. It's not necessarily about simply selling my firm, it's maybe partnering and creating more wealth and building that where I think perhaps these advisors going RIA, especially from the wires, are seeing that as a more attractive way to do it rather than simply selling their practice to the advisor across the hall at a wire. Um, One of the things that comes up is how to build a practice that will be attractive. And it was interesting in our meeting, they said, well, a lot of times they'll be looking at a practice, either, the buyer will be looking at a practice to buy and say, okay, well, once I start hitting my fist on the wall, it's all sheetrock and there's nothing behind it. There's nothing really, really solid about this business that I want to buy. Um, Maybe share a little bit with the audience, like what should people be thinking about who are running businesses that either want to partner and be attractive to that partner, or maybe they do want to monetize it and simply sell it. I'm sure there's certain fundamentals that they should be focused on other than just simply gathering assets.
I agree with you. So I think there are a lot of ways to answer that question. The first piece of advice that we give anyone contemplating selling their business is just continue running your business, right? Like there are a lot of things that you should not do because you think that by changing what you've already built, you might be more attractive in the market. By that, I mean, this is not the time to fire two people so that you can increase your bottom line. Because a buyer is just going to look at that and say, well, why did you fire those two people? Like now all of your advisors are managing 200 households. The first thing we're going to have to do is hire two new advisors because everyone's overworked, right? Or, we have just like completely shut down all of our marketing efforts because we're not going to need them going forward. And a buyer is going to come in and be like, but isn't that how you gained all of your business? We're just going to have to spend a bunch of money like reconfiguring your marketing process that you've shut down, right? Or, we've never done client taxes before. We're going to hire 3 CPAs and start doing taxes. And it's like, what if that doesn't work? Right. And now you just have 3 CPAs on staff. Like the best thing that you can do is just be proud of the business that you created and run it to the best of your abilities. Um, with that said, um, this would be a good time to start thinking about your wish list and also your non-negotiables. right? And I don't necessarily mean, I don't want to go somewhere that's going to take all of my portfolios, sell everything off, and reinvest in their buy sell list, right? Like that's kind of a given. Same thing as like, well, our average fee is 75 basis points. We can't all of a sudden make everyone, 125. Of course not. It's in your control. Don't pick someone that's going to force you to do that. But it is a good time to say, hey, I don't want to be a manager anymore. I want to go somewhere where, our employees can be taken care of, but I don't have to do their annual reviews anymore. I want to go somewhere where, I can join an investment committee because I really enjoy, investment research. I want to go somewhere that, I never have to think about compliance anymore or running payroll anymore, right? Like those are all the types of things that you can kind of start thinking about that will help inform who your advisor will end up taking you to because they know who's going to solve all of the issues that you yourself are trying to solve for. Understanding that your wish list is probably 65% baked and the other 35% will come to you as you actually start to meet other firms out there and understand their capabilities, which will help inform what it is that you're looking for because you might not even know that it exists as a solution, right? And that's kind of the beauty of going to market and just kind of pulling your head out of the sand and seeing what exists out there.
And if I'm an independent operator right now and I reached out to you and said, look, I want to monetize this, I want to sell this. How should they think about the timeline for that? Can you talk about that a little bit?
Yeah. So assuming that we are going to market fully, right? Like you don't already have a buyer in your mind and just kind of need
Right.
like an
They don't know anything. They're just like, I heard you on Derek's podcast with the Advisor Lab. This sounds great. I don't know where to go. I want to put my market, and this is just garden variety REA, like right in
oh,
your.
yep. So what we say is 6 months is fast, 10 months is long. Everything else is really dictated by the client, right? So we had a bunch of people, for example, last year who were like, we got to get this deal done by the end of the year because we don't know who's going to get elected and what happens to cap gains. So we had a bunch of people who were like, we have to get this done in 6 months. We're like, oh God, wouldn't recommend it, but we can if we need to. Um, I think a good rule of thumb is that within the first 3 months, you will understand what the market looks like and what the market thinks you're worth. So in the first 3 months, we are getting to know the firm, putting together a prospect list, putting together a SIM is the acronym for confidential information memorandum, basically a marketing summary of who the firm is, taking them to market, meeting with the prospects, requesting proposals, receiving those proposals, running analysis on those proposals, and giving the client a really good understanding of their value and also everything else that's not their value that's important, right? Like what do market restrictive covenants look like? How are people thinking about how you're compensating your employees? What kind of like reporting lines and governance do you like and do you not? From there, the process just kind of continues to unfold as we hone who the right partner is for you. So I'd say within 6, 7 months, we're probably post LOI. We're exclusive with one firm, and we are beginning to negotiate the purchase agreement and working on diligence.
Let me ask you this, because interest rates have obviously been elevated since 22, and we could debate all day whether they're going to start cutting. I know they think they're forecasting 2 to 4 cuts now. Who knows? No one knows because of the unpredictability of the tariff situation. But for now, rates are higher.
Mhm.
How does that work? Like if I'm selling, is this a good time to be selling? Because, well, if rates are higher for borrowing and I'm going to borrow money to buy the business, um, that seems like it's going to be a more expensive proposition, which should slow down purchases. Or is it driving down the value of these REAs that they're selling at? Like, is it having an impact on that multiple where rates are now? Or does it not even matter? Like I was on a call yesterday, big private equity firms making a purchase and they don't care how rates are because they're getting the company at such a good price for them. You know what? I'll borrow at 7% and refi in 2 years. I don't care. Like, how is that dynamic playing out from your vantage point?
Yeah, well, there's a lot. So, I mean, the nice thing about RIAs from a buyer's perspective is that they are annuities, right? Very predictable cash flow. You don't see a lot of churn in client movement. You know, barring the craziness of the markets over the last, few days, markets go up over time. And then if there is organic growth X market that's been proven prior to the sale, I mean, you can expect that to only be supercharged when they combine with a larger entity with a more sophisticated marketing engine. So you can really, the only thing you can predict about a forward-looking model is that it's going to be wrong. But with some certainty, you can predict what cash flows are going to look like into the future. So there is a fair amount of certainty compared to other industries within RIA M&A in particular. So I think that's kind of the backdrop. And then the other side of it is that interest rates have been high for a while now. They are lower than they were 2 years ago. So the market has already taken interest rates into account, and valuations are kind of at all-time highs as far as multiples go. I think where we've seen the most change is in the amount of equity that's being offered by buyers to account for the fact that borrowing is more expensive. So, by and large, and of course, to every rule, there are exceptions. By and large, it's hard to come across an all cash offer these days. The way that deals are typically structured is, 60 to 70% of deal value paid at close. Another, call it like 15, 20% paid in the form of a retention payment based on client retention over the first year, and then an earnout at the end of 3 years based on your ability to grow. And that upfront payment, and sometimes the retention and the earnout as well, have an equity component involved. So of that, call it 70% that you're getting up front, maybe, 25, 30, 50% of it is in buyer equity. That gets given to you as a tax-free exchange. So it's kind of like beneficial all around. Like, you're not paying capital gains because it's a tax-free rollover. So you're deferring a bunch of tax. If you believe in the company that you're selling to, it's an attractive proposition because the equity that you're rolling into is growing at a rate that's faster than you're able to grow on your own. And it's priced at a higher multiple, right, than what you're receiving. And from the buyer's perspective, it's cheaper to buy the business because they're not taking on 100% debt to finance the deal.
Right. Okay.
So listen, we might see that change as interest rates continue to go down. Maybe buyers will become more flexible, or maybe not, because this seems to be a strategy that resonates on both sides. So maybe, the higher interest rate environment may have found a solution that otherwise would have just been cash forever. That's actually just more attractive to everyone.
Right. Right. And I think a lot of individuals that are listening to this are probably just in the same, they're thinking, should I just strike while the iron's hot and sell now? Or is it going to be maybe more lucrative to wait, who knows, a year, 2 years, 3 years, like trying to figure that, right? This is always the decision people go through. I'm saying it right now. I need to buy a car. I'm like, I guess, should I buy it now before tariffs go up or just buy American? It's not the same thing, but there's a couple stats that I wanted to share with you and ask you a question.
Sure.
So 7% of RIAs in this country, which is about 1,200 firms, control 74% of the total assets in the RIA market. 60% of the RIA firms are under 100 million in AUM and only control 4% of the assets. The question for you, Jessica, is the first stack going to continue to increase? In your opinion, you're going to see that 74% go to 80, 85? Or is that 60%, maybe their control is going to increase? Because it tells us a lot about more people are going to keep going RIA and maybe increase that 100. Like, which one do you think is going to actually grow?
That's such a good question. I haven't heard
Came
this.
up with it all by myself too.
I love it. It's A plus. Good job. That's such a good question. So there is an interesting thing happening right now with the larger RIAs, which
Right.
is everyone wants to be the preeminent RIA, right? Like everyone wants to be the 100-year firm. Everyone wants to be the consolidator, not the consolidated, right? On that side of the spectrum. Um, so I would be surprised if we end up seeing like a bunch of mega mergers, because all of them believe that they have a secret sauce and an ability to kind of sustain not being bought by a competitor. Um, on the smaller side, that is probably a case by case basis. There are a lot of people who really enjoy running small practices as a lifestyle business and have no aspiration of going from 100 million to a billion. I think statistics show us there are fewer $1 billion firms than there are $100 million firms because it's difficult to grow your business from a lifestyle practice into like an organization, right? And the reality is most firms who go independent with 100 million, 200 million, 50 million, whatever it is, are going independent not because they want to be entrepreneurs, but because they're so tired of what's happening in the wirehouses that they're willing to kind of be these like reluctant entrepreneurs for the sake of being fiduciaries, and aren't aspiring to be CEO and have 10 people report to them. So I think that there is a natural dispersion, like you just pointed out, among people who have, the goals of becoming the preeminent firms in the country, and those who are very happy just taking care of their 100 clients and want to keep it that way and are intentional about keeping it that way.
Right.
There are more platforms today than ever before to help firms break away from wirehouses and go independent and provide them kind of a softer landing than just having to, go find an attorney and create a company on their own. So I do think that the dynasties and the sanctuaries and all them of the world have provided a much needed resource in the space to allow smaller firms that just before just couldn't do it for regulatory reasons to go out and be independent. And I think time will tell, right? How many true entrepreneurs there are in that group that are able to ascend, into the, billion plus range. There's so much going on right now. And although like wealth management has existed as an industry forever, I think we're kind of in our infancy as far as what the near future looks like, just given the amount of activity that's happened. And I don't even mean M&A, right? There's more wealth tech that's available than ever before. People are embracing AI, which they couldn't do because it didn't exist like this, 5 years ago. There are podcasts educating people that didn't exist 10 years ago, right? There's so much happening and so much information that's available to people. It feels kind of impossible to predict, but it is very exciting to sit back and watch.
Well, I'm just amazed that we went like 37 minutes before we brought up AI. So that's pretty interesting.
You're actually talking to a bot right now.
But that's a good segue because I want to end with just talking a little bit more about you. And I think from a human level, because the AI boom is amazing. And I think and I'm old school, but I believe it's actually putting the human experience even higher on a pedestal. It's even that much important to develop relationships with people and sit with them and more than just, having a super efficient business because of AI. And I know you agree with that too. And I know that's a big part of your mission's statement really in your business. But for our listeners, I saw, looking at your bio, I know you're in Connecticut, and obviously you have 4 kids, your husband tax, but I saw you bake. And I wanted to ask you, because I'm a cook. That's a strong word. I cook for my family. What's your favorite dish to bake or cook?
Oh man. Well, I am famous for my Nutella chocolate chip cookies.
Okay.
That is like a household staple that gets brought to everyone's house anytime we're invited anywhere.
Yeah.
We have this like wonderful divide in our house where my husband is from Texas and we have two smokers at our house. So he's in charge of the meats and I'm in charge of the baked goods.
Oh,
And
wow.
it's a good time coming and visiting the Politos.
I'm sure it's a beautiful family. This has been a joy. Jessica, thank you so much for coming on the show.
Yeah,
And
thank you so much for having me. It was a pleasure.
absolutely. Hopefully, we'll have you on again soon.
Sounds great.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Cyan Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Cyan Investments nor its affiliates and/or subsidiaries warrant its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Cyan Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Cyan Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.